Well, the U.S. Central Bank, the Federal Reserve, or the Fed, is forecasting that high inflation and tight financial conditions is set to push the U.S. economy into an imminent recession. The sobering forecast was noted in the minutes of the Fed's November meeting, which stated that Fed members, quote, viewed the possibility that the U.S. economy would enter a recession sometime over the next year, end quote. In those meeting minutes, the Fed also outlined that stubbornly high inflation, sluggish growth in real private domestic spending, a deteriorating global outlook, and tightening financial conditions would all drive the U.S. economy into a recession. Now, the Fed also noted that although U.S. GDP growth rebounded in the third quarter, recent data suggested that economic activity in the near term appeared likely to expand at a pace below its trend growth rate. Stubbornly high inflation is seen as one of the main reasons behind this, with the U.S. still seeing inflation of 7.7% in October, which is still significantly higher compared to the Fed's inflation target of 2%. All right, moving on to New Zealand, where the country's central bank hiked interest rates on Tuesday by a record amount as it tries to get inflation under control. The Reserve Bank of New Zealand increased its benchmark rate by 0.75 of a point to 4.25%. It is the first time the bank has raised rates by more than half a point since introducing the official cash rate back in 1999. The new rate is the highest in New Zealand since early 2009. New Zealand's inflation rate is currently 7.2%, well above the bank's target of 1 to 3%. The nation's unemployment rate is 3.3%. The bank also sharply revised upwards its projected peak for its benchmark rate, which it now expects it to reach 5.5% next year before it decreases.
Committee decided today to increase the official cash rate from 3.5% to 4.25%, so a 75 basis point increase. The committee agreed that the OCR needs to reach a higher level and sooner than previously indicated to ensure that inflation returns to within its target range over the medium term. Core consumer price inflation remains too high, employment is beyond its maximum sustainable level, and near-term inflation expectations have risen. So this is quite a heightened inflation